Hello, everyone. This is Stetson University with Austin, Jonathan, CJ, and my name is Ivy. We will be presenting our sell recommendation for Chewy with implied downside of 49% because of the following reasons: a limited accessible market, fierce competition, deteriorating customer trends, and capped operating margins. I'll pass on to Jonathan.
Thank you, Ivy. I'll be starting with Chewy's positioning in the industry, then moving into market accessibility and competitive pressures. Chewy is an e-commerce retailer solely focused on pet food and supplies. 75% of its revenue is derived from its pet food segment, with the remaining consisting of products and prescriptions. Chewy ships only within the continental United States. And the United States pet industry reached approximately 100 billion in revenues in 2020, with an estimated 4.5% forward compound annual growth rate. In 2020, approximately 41 billion was spent on vet care and other services, 20 billion on supplies, live animals and over-the-counter medicine, and 38 billion on pet food and treats. Of these revenues, about 22% were generated through online channels. Now, online growth was boosted in 2020 due to the COVID-19 pandemic, but will likely fade as vaccines are distributed. Chewy can only access a small portion of industry revenues. Chewy's solely e-commerce model blocks out significant consumer spending. Less than 41% of dog and cat owner spending is accessible to Chewy. Fuzzy numbers surround the pet industry as well. Chewy cites the APPA. However, the APPA consistently and significantly reports higher metrics than the US Census, specifically in the number of households which own pets. The APPA data may be less reliable than the US Census, as the census requires individuals to answer, but the APPA uses an opt-in survey, leaving a bias towards pet owners. Chewy can only access a fraction of the market, and the market is smaller than it claims, meaning that Chewy's guidance has been significantly overstated. Regardless of the market size, Chewy still faces significant competitive pressures. In the flag matrix, one can see that almost every notable competitor offers products in the same segments as Chewy. In addition, brick and mortar competitors offer additional services that Chewy cannot. Competition is intensifying as competitors more closely duplicate Chewy's value proposition and provide alternatives to Chewy's subscribe and save model, AutoShip. Chewy's market share has been hurt by this competition. From 2019 to 2020, Chewy lost about 3.43% of its market share in the same period that consumers were forced to migrate to online shopping. Chewy no longer has a unique value proposition and lost market share before reporting a single dollar of profit, which Austin will cover in financial analysis.
Thanks, Johnny. This crack in Chewy's growth story has spread to its top line as well. Between 2017 and 2019, Chewy's revenue grew at an impressive 56% compound annual growth rate. However, revenue increased by a lower absolute amount in 2019 than 2018. Looking forward, we project revenue to increase meaningfully, but at a slowing rate, with revenue growth declining to single digits by 2025. Chewy's revenue growth rate is likely to decrease for one simple reason: unsustainable customer acquisitions. As of 2020, between 32% and 44% of US pet-owning households were Chewy customers or had churned from the service. Chewy's pool of potential prospects is dwindling, and remaining households are increasingly resistant to Chewy's offerings, as indicated by rising customer acquisition costs. We believe that the market overestimates Chewy's growth potential in light of customer acquisitions. But this is only one half of the revenue equation. The other half is net sales per active customer, or NSPAC. An average customer spends much more in their second year than in their first, and so on. However, this trend is static over time between cohorts. Chewy has not successfully captured a greater share of customer wallet when adjusted for years since acquisition. This flat trend allows us to project revenue with confidence. Further, cohort NSPAC is skewed by survivorship bias. Chewy does not explicitly disclose its customer retention rates, but we were able to derive them from its S1 filing. A case study used by Chewy in its S1 was its 2015 cohort. NSPAC increased by 160% between the cohort's first year and its second, but cohort net sales only increased by 55% in the same period. The only way that these numbers reconcile is if 41% of customers had left the company. This same logic applies to all other cohorts for which data is available. In all, 56% of customers leave the service in their first 3 years. The only customers contributing to upward NSPAC are those that use the service enough to stay. With predictable NSPAC and churn rates, we were able to create an empirical, data-driven model to anticipate Chewy's future revenues at the cohort level. This provided us with a range of revenue CAGR estimates between 12.4% and 16.4% through 2027, with most of that growth front-loaded. The discrepancy in those figures lies in the fuzzy numbers Jonathan mentioned earlier, whether APA or census data is used. But how will these revenue projections trickle down to the bottom line? Chewy's gross margin has been trending upward since 2016, reaching 25% in 2020. But management expects only a marginal improvement to 28% over the long term. At the same time, brick and mortar competitors realize higher gross margins in the 31 to 43% range. This difference lies in margin accretive services added at physical retail locations and reduced pricing power in the online marketplace. These factors impede Chewy's ability to drive significant increases in gross margin going forward. Ideally, Chewy would exhibit downward trending operational costs to make up for this gross margin disparity. However, G&A has not varied significantly as a percentage of revenue and is expected to remain static, as many significant expenses cannot be defrayed across an expanding revenue base. Marketing expenses are expected to decrease to a long-term guidance level of 3% of revenue, but coupled with rising customer acquisition costs, this level of guidance does not bode well for Chewy's growth prospects. Coupling expense ratios with our revenue model, we anticipate net margin to gradually increase to 7% by 2027, achieving a full year of profitability in 2023. Most of Chewy's expenses will not see substantive returns to scale, and gross margin and G&A caps limit potential expansion of Chewy's bottom line. Our valuation takes these factors and couples them with a relative valuation approach. We issue a sell recommendation with a 49% downside. We valued Chewy using a blended valuation method split equally between residual income and relative valuation. Residual income is the most justifiable absolute valuation method, as Chewy does not pay a dividend and posts negative and inconsistent free cash flows. Our model uses a pro forma-based approach through 2027 to incorporate the customer trends discussed earlier. Using revenue estimates at the high end of our range, income statement expense ratios based on long-term guidance and historical trends, a 7.3% cost of equity derived from Fama French, and a terminal growth rate based upon long-term pet industry projections, we arrive at a price target of $44.30. I'm going to hand it to CJ to discuss our relative valuation.
Thanks, Austin. At the time of evaluation, there was not an adequate sample of publicly traded pure-play pet retailers. The comparators used are all specialized e-commerce companies which are disrupting their traditional brick-and-mortar segments with similar market exposure. When comparing Chewy's returns against a standard benchmark, we cannot produce statistically significant results, but against these comparators, its returns have a correlation coefficient of 0.94. To include growth expectations in the relative evaluation, we temper the trailing 12-month price to sales multiple by weighing it against the one-year forward price to sales multiple. Using the trailing method, we found that Chewy is overvalued with a price to sales ratio of greater than 6 compared to our benchmark average of 3.4. Using the forward method, we found the ratio to be 4.9 compared to 2.9. Combining these methods, we arrived at a weighted price target of $59.85. There's a degree of uncertainty when valuing a growth stage company such as Chewy, and we identified 9 key risks which may alter our evaluation. Many risks are associated with factors which may lead to Chewy outperforming projections, but these risks ultimately boil down to variations in income statement line items. These variables are stress tested through a Monte Carlo simulation, and even in the 95th percentile of scenarios, Chewy did not meet its stock price at the time of evaluation. On to Ivy with ESG.
Thank you, CJ. The critical components of our ESG analysis includes logistic network, philanthropic initiatives, and ownership structure. The company has an efficient logistic network of 8 fulfillment centers across 7 states that allows coverage to the entire continent of states in under 3 days. With significantly fewer centers than competitors such as Amazon and no manufacturing, Chewy's environmental impact is minimal compared to other e-commerce companies. On the other hand, Chewy focuses on pet-centric charities. Chewy has been donating food supplies and capital to local pet shelters and rescue for a network of 3,000 nonprofit organizations. Simultaneously, the retailer is known for providing a high level of customer care and compassion. It sends personally notes to new pet parents and gives to those whose pets have passed away. Chewy's customer service ethos unfortunately deflates its operating margin, impacting its bottom line. The same level of care does not apply to the company Class A shareholders. Chewy is heavily controlled by BC Partners, which controls 76% of total shares, but more than 97% of total voting rights due to Chewy dual class share structure. 8 of 13 board members belong to this private equity firm. The board is lacking heavily in diversity, with only 2 women and 4 independent directors. BC Partners also own PetSmart, which is a direct competitor to Chewy. This causes the interest of the board to be divorced from those of Class A shareholders. The dual class share structure poses a variety of challenges to Class A shareholders. BC Partners may sell off a significant portion of its stake in Chewy. BC is already entering into a delayed sale of Chewy stock, which will vest in 2023, eventually increasing Class A float by 24% in 1 day. Further sales of BC's stake may be catalyzed by Chewy collateralization of $4 billion of PetSmart debt. Additionally, BC controls both sides of the main relationship that Chewy has with other companies under BC umbrella. Therefore, the firm is incentivized to graft deals which disproportionately benefit the wholly owned subsidiaries only. And finally, any potential acquisition is not likely to meaningfully benefit Class A shareholders due to BC controlling interest. We again really stress our self-recommendation because Chewy can only access a small fraction of the current projected market. Competition is getting intense and Chewy's value proposition is no longer unique. The company struggles to acquire and retain customers, and it suffers from structural margin caps that severely limit profitability. Thank you for your listening.
Thank you. Judges, please turn on your videos. As a reminder, stay muted unless you are speaking. I will start time as soon as the judge utters the first word. Time will end at 10 minutes. Please feel free to begin.
Yeah, hey guys. So your competitor comps, Stitch Fix, Revolve, Wayfair, and 1-800-Flowers are totally different businesses. And you're running forward price to sales against that universe. But you had said you modeled out to 2027 growth in revenues and what have you. Walk me through what the income statement looks like, 6, 7 years out. Operating margins, net income margins, how big's the top line?
Sure. So again, when we're using our comparators, we ran into a major issue of trying to have Chewy go against any other benchmark. For example, both the S&P and NASDAQ had a correlation coefficient of below 0.3. So we instead looked at companies that, again, had these similar markets where they have different models that like varying between them. But because they have all this similar market exposure, as various things happen within the market, they will either increase or decrease.
Could you expand on that answer a little bit? Like, do you have an income statement that you've modeled, since both your valuation methods rely heavily on that?
Yes, we pro formed out Chewy's income statement based upon a number of factors. So I'm just going to take you through from the top line down to the bottom line. So for the top line input for revenue, we actually modeled that at the cohort level, right? So we applied a range of assumptions to the cohorts through the year 2027, and then summed up the cohort revenues to arrive at a revenue estimate for Chewy in that given year. And the overall CAGR of these estimates came to between 12.4% and 16.4% for that top line number. And I can get more into the cohort-based calculations if you want. Gross margin, we assumed that Chewy's gross margin will gradually trend upward to 28%, which is management's own long-term guidance. And then going down, we treated G&A expenses and marketing expenses as a ratio of revenue. And G&A expenses have remained relatively static, but Chewy is posting initiatives to open new automated fulfillment centers and other things of that nature to drive incremental profit. So we factored in a decrease in G&A over the time horizon by about 3%. And for marketing expenses, Chewy has a stated target of marketing expenses being at 3% of revenue, which we again carried out to the end of the time horizon. And then that essentially takes you down to operating profit.
And I would like to ask you about the terminal growth rate. Where do you get this terminal growth rate? You've mentioned from industry projections.
So we had the terminal growth rate. Let me pull up the slide here. We had the terminal growth rate that came from Grandview Research, and we also had other estimates. Some estimates for the world pet industry for e-commerce specifically was 11.3%. However, for the US industry, they have typically been lower, as the United States already makes up a significant portion of the world's pet market, if that makes sense.
I also want to add that because our time horizon is out to 2027, that changes in the terminal growth rate of 1%, 2% either direction have a relatively small impact on the price target.
Okay, thank you.
One area I want to take it, I thought it was notable that you computed a customer churn rate from a retention standpoint. I'm trying to follow it. Just maybe spend a minute or two talking us through the analysis in terms of how you determined whether or not clients are being retained.
Okay, absolutely. If we could go back, yeah. So Chewy doesn't make any disclosures about customer retention, except for these two graphs from its S1, right? One of them is net sales per active customer by cohort by year. The other is revenue by cohort by year. And what we had to do is we had to go through and convert these graphs into actual data we could work with, And so for the NSPAC side of things, 2015, for example, increased by 160% between 2015 and 2016. And the total revenue from the cohort only increased by 55%, right? But at the same time, customers in that cohort were spending 160% more, right? So the only way that those numbers can really work out is if customers had left. Because if every customer is spending 160% more, why did revenue only increase by 55% from that cohort?
And how do you explain the discrepancy that we can observe between the market prices and the valuation price that you derive from your model, your expected price? How do you explain that discrepancy?
So there's several factors when when the rest of the market is looking at Chewy as a shareholder. So firstly, it could be them overlooking the churn rate. We know that in an earlier version of in CFA for the state championship, a group that was looking and evaluating Chewy did not take into consideration their churn rate that they had already gone through. There could be reduced customer expectations, like the cost of acquiring a new customer could be less and less. There could be expectations of Chewy to be able to continue its forward growth rate, and a lot of optimism for Chewy generating. It had a quarter of profit, but as far as what we found it based off of the data and the fundamentals, and the could just be missing of certain information or overall market optimism.
I would like to also add that many analysts are using churn rates similar to Netflix, which is a streaming service. And from that, you don't get a reminder every month in the form of a physical package at your house being delivered. For example, if you get tired of Netflix, you can still use a different streaming service and not worry about being subscribed to Netflix. But when you are constantly getting these packages that you have been subscribed to from Chewy, not only are you reminded that you are still subscribed, if you're buying that pet food already, you have no need for it. So Chewy will have and does have a significantly higher churn rate, which hasn't been accurately accounted for in that analysis.
Okay, thank you.
I liked your customer acquisition cost analysis on slide 9, but I'm wondering how you arrived at the conclusion that 32 to 44% of customers have already been acquired.
Absolutely. So we have the churn rate calculations that are essentially set in stone for all historical cohorts, and we also have the overall size of the market using Chewy's own numbers or the U.S. Census, right? The number of pet owning households in the United States. So we can calculate the number of customers that have churned from Chewy since 2013, and we have the number of customers that Chewy has because they disclose that information. So the 32 to 44% is the sum of customers that have churned from Chewy and Chewy's current customers divided by the overall market size as reported by either the APPA or the U.S. Census.
Talk about their distribution, billing, fulfillment, shipping, really relative to an Amazon.
So Chewy depends heavily on third-party companies to ship and to deliver their products, such as FedEx or USPS and UPS. As we mentioned, they currently have 8 fulfillment centers, but they have already recently added another two fulfillment center, one of which is a limited SKU facility, and the other one is an automated one, which they believe will increase the operational efficiency by between 30 and 60%. However, we believe that their plan to expand their network over the next 2 years will also create another burden on their operating expenses. So in general, we think they are facing a lot of risks because of how they are locating their fulfillment centers, as well as their reliance on third-party shipping companies.
One of the investment risks I believe you articulated around the end was potential to be acquired. I think that point may have been a bit maybe rushed or capped off, I guess I'd appreciate just hearing more about
Fine.
what you think this firm might.
Sorry, Marcus. Thank you, Stetson University.